So guys, I'm making this video to generate awareness about a very deadly mistake that many traders are making on expiry day. Okay. So expiry day, for those of you who don't know, used to be very few and far between up until a few years back. It was once a month for Nifty, and it used to be more frequently for Bank Nifty, but nonetheless, it was more of an exception kind of a day. But what has happened recently is that more and more expiries started to happen, more and more people started to participate. So now we have an expiry every day, right? So we have mid cap and Fin Nifty, then Bank Nifty, then Nifty, and then of course Sensex, right? So every day is an expiry, and what has happened is that people have started believing that it is a shortcut to make a lot of money. But the reality is that it's not very easy to just go out every day and make money, right? And secondly, if you don't have enough knowledge about what you're doing, you are prone to make some very serious mistakes. And one of the mistakes that I'm seeing that a lot of people are making is that they realize that these expiries are, very turbulent, like market goes up and down, it's a little volatile. So what they do is they try to stay out of the market till the afternoon, let's say around 2:30 or even 3, right? And after 2:30 or 3, after the market has done all its ups and downs, now they sell certain options which they believe are going to expire worthless. So for example, if the market has been going up and up throughout the day, it's very reasonable to expect that market would not come down and break a certain level on the downside, right? So by selling an option, let's say in this particular case, selling a put option, even if the premium is low, they expect to make money on expiry days. So last week I was having a conversation with one of the traders, and he told me he sold 10,000 quantity, right? 10,000 quantity of a Bank Nifty option of 25 rupees. So basically he wanted to make 2.5 lakh rupees, right? So the day was already done. Most of the day was done. An option was like, barely 25 rupees. And he was expecting this option of 25 rupees to go down to 0 and eventually make 2.5 lakh rupees. Now, as luck would have it, this option did go to 0 eventually, but not without hitting the stop loss of this trader first. So this option went from 25 rupees to about 75 rupees, hit the stop loss of the trader, and then eventually went down to 0. Okay. So now some of you might be thinking that, okay, it just seems like a bad luck, things like this happen. But the reality is that these incidences happen more frequently than you realize, and they're happening because of a very simple phenomenon called gamma effect. So in option pricing, we learn that the price of an option can be broken down into different components, and they can be explained in terms of the direction, in terms of their time value. And one of the components that we have there is called gamma. And gamma is nothing but the second derivative of price change. Okay. So think about in physics, we learn that acceleration is the second derivative of change in distance. So in the same way, gamma can be considered to be the second derivative of price, right? So the rate of change of price of the underlying is what basically gamma measures. So without getting too technical, what I want to tell you is that as we get closer and closer to expiry, let's say this is expiry, and as we get closer and closer to expiry, the effect of gamma starts to become higher and higher, and it becomes very pronounced for at the money options. Okay, out of money options are fine, but at the money options are most vulnerable to this gamma effect. So if you sell an option later in the day, closer to expiry, what will happen is that most of these options which are out of money, they don't really have any premium left, right? So what you will be forced to is sell at the money option. And if you sell an at the money option, of course, the premiums are going to be low, so you have to sell with a bigger quantity. And the risk there is that this option can jump very quickly to a very high price, hit your stop loss, and then maybe eventually go to 0. But you will have to either sit on a big MTM loss, or you have to incur the big loss itself. Okay. So now let me show you one example of what happened last Friday. So this is Sensex. It was very, very bullish yesterday. And a gentleman who I know got a little carried away, right? And thought that, this is such a strong market. So somewhere close to 315 or 320, he sold 71,500 put option, this guy right here. And I believe he sold it for somewhere around 20 rupees or so. So same thing happened. Same thing happened with Sensex. It was looking like very good. At some point even I think went down to 5 rupees or so. But then again, it went up to all the way to 40 rupees. Okay, 40 rupees. And then of course the losses became a little too big. So the trader had to come out, when eventually it came down and settled down to 16 rupees. So the point that I'm trying to make, guys, is very simple. Do not sell options later in the day, and definitely don't do it with large quantities, because you stand to lose a lot more than you stand to make.